Talk more about the data today and the market. Joining us today is Ed Yardeni, president of Yardeni Research, who joins us here at Post 9. Happy holidays, Ed. Good to see you. Can you bundle all this data into a couple of phrases?
Yeah, I think the economy in terms of final demand, GDP growth is still quite good. The labor market is funky with a lot of different things going on in that marketplace. But the conclusion is productivity must be extremely strong. And that's good. I mean, that actually helps most consumers because productivity growth is what drives the standard of living. Wages rise faster than prices.
How good can that get next year?
I think it can get very good. I mean, this year I think real GDP is running around 2.5%. Some of that was tariff related in the first quarter was the weakness, and then some of the weakness in the fourth quarter because of the shutdown. But the second and third quarters are very strong. I think next year we'll have 3.5% real growth with a labor force growth of maybe, something between 0.5 and 1%. So the productivity number should be at least 2%.
So you're well above consensus on real GDP next year.
Yeah, I think so because, I've been rooting for the roaring 2020s and it's worked out quite well so far, and I'm going to stick with it.
But what about the weakness in the labor market?
Well, I think there's a lot of things going on there. I mean, clearly with the restricted immigration, with the deportations on the supply side, and then, of course, companies, I think, are all looking at artificial intelligence and trying to figure out whether that might be able to increase the productivity of their current workforce.
Do you think that's why we're not seeing more hiring?
I think that's a big part of it, absolutely. And I think the net result is going to be productivity growth continuing to improve. It has been improving.
So do you imagine a world where the Fed keeps cutting rates next year?
I don't.
You don't?
I don't, because I don't think that lower interest rates are really the solution for what's ailing the labor market. I mean, part of the problem is we've got a lot of kids coming out of colleges with basically the same kind of degrees. They just don't really match the skill sets that are required by businesses right now, and so it's going to take a little time to sort that all out, but I don't think lower interest rates do it. The idea of lower interest rates is to stimulate demand, and demand looks pretty strong.